Hey everyone, welcome back to Corporate Decoder. Today we are diving into TPG Private Equity Opportunities LP's latest quarterly report. And let me tell you, this one offers a fascinating glimpse into a company that's essentially a fund of funds manager that's still quite young, so we'll see how they're doing so far. This report covers the period ending June 30, 2025 and gives us a look at their financial health and operations. With TPG being such a big name in private equity, understanding how their opportunities fund is doing is key for anyone interested in this space. TPG Private Equity Opportunities LP, or TPAP as they call themselves, is a relatively new player in the world of investment funds. They were formed in August 2024, which means their operations kicked off only recently around June 2, 2025. This report is one of their very first looks at their financial standing since they really started investing. Their goal is pretty straightforward: to make money for their investors called limited partners by putting their money into TPG's various private equity strategies. Think of it like a diversified investment through one door. Let's jump right into the numbers, looking at their statement of assets and liabilities as of June 30, 2025. We see a company that's rapidly building its asset base but is also carrying significant initial expenses. Total assets stand at a solid $344.2 million. Most of this, $16.4 million, is in investments, with an additional $18.2 million in investments in affiliated funds. They also have a substantial $156.4 million in cash and cash equivalents. On the flip side, their total liabilities are about $13.2 million. A big chunk of this, $7 million, is in organizational and offering costs payable. This makes sense for a new company still getting its footing. They also have $2.4 million in servicing fees payable and $1.6 million in accrued performance participation allocation. It's important to note that for the period, their TPOP's net assets are $3026.99 million. This structure shows a company in its growth phase bearing the initial costs of doing business. Now let's talk about how they performed financially. For the 3 and 6 months ended June 30, 2025, TPOP saw a net increase in net assets from operations of about $10.8 million. This positive result was largely driven by a net unrealized gain of $19.8 million from investments in derivative contracts. On the expense side, things were pretty high as expected for a new fund. They incurred $9.1 million in total expenses, including $6.7 million in organizational expenses. This meant they posted a net investment loss of $8.4 million. So basically, the gains from their investments, even on paper for now, outweighed their operational costs for the period. This is a good sign that their investment strategy is starting to show promise, even though the startup costs are high. Okay, let's dive into what they're actually investing in. This schedule of investments gives us a great look at their portfolio. As of June 30, 2025, their investments are spread across various sectors. They have exposure to consumer services, energy transition, financial services, healthcare, and software and services. A significant portion of their investments, about $136.7 million, are in what they call portfolio companies. For example, in financial services, they have investments like Cliffwater and Creative Planning worth $20 million each. In healthcare equipment and services, Soulstrips is valued at $27.5 million. This shows a clear focus on private equity style investments. They also invest in unaffiliated investee funds totaling $23.5 million and affiliated investee funds for $18.2 million. These are essentially investments in other investment funds. Interestingly, a large portion of their investments, some $149 million, are categorized as level 3 under the fair value hierarchy. This means these are investments where the fair value is based on unobservable inputs, requiring them to use significant judgment and estimation. This is typical for private equity, where there aren't always readily available market prices. Let's look deeper into those level 3 investments. For portfolio companies valued using level 3 inputs, they use valuation techniques like market comparables and discounted cash flows. For instance, they use LTM EBITDA multiples ranging from 17 to 32.5 times. The weighted average in this range is 26.1 times. This tells us they're valuing companies based on their past performance and future potential. Using multiples, similar companies are trading at or valued at in deals. A higher multiple generally means a higher valuation. They also use net asset value, or NAV, as a practical way to value certain investments, particularly in investee funds. For their financial services segment, they have 3.7 million invested in affiliated investee funds. In GP-led secondaries, another 14.5 million is in affiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. For the consumer services sector, they have 13.9 million in unaffiliated investee funds. Diving into the notes, we find important details about their accounting policies. They are following US general accepted accounting principles and are structured as an investment company. A key point is their consolidation policy, where they consolidate subsidiaries like TPG US Actor Dollar if they have controlling financial interests. They also mention non-controlling interests, which account for ownership stakes held by other entities in consolidated subsidiaries like TPG US Agrido if they have controlling financial interests. They also mention non-controlling interests, which account for ownership stakes held by other entities in consolidated subsidiaries. Their accounting for fair value is crucial, especially for those level 3 assets. They explain the 3 levels of the fair value hierarchy: level I for quoted prices, in active markets level 2 for observable inputs, and level 3 for unobservable inputs. Most of their private equity investments fall into level 3, meaning their valuations rely heavily on their internal assessments and external valuation firms. This is where judgment plays a big role. A really interesting part of their structure involves the performance participation allocation. The general partner, which is an affiliate of TPG, gets a 12.5% cut of the total return. This is subject to a 5% annual hurdle, meaning they only get their share if the fund's performance exceeds that benchmark. They also have a high watermark, which means they only earn incentive fees on new profits above the highest value the fund has ever reached. This is a standard way to align the interests of the fund manager with the investors. Then there's the management fee. For Class SD and R units, they pay 1.25% of the transactional NAV annually. And for RSRD and RI units, it's 1.00% per year for the first 36 months after the initial closing. This fee is pretty standard in the private equity world. It's essentially their payment for managing the fund. They also have servicing fees, which are paid to TPG Capital BD LLC. For Class S and RS units, this is 0.85% annually, and for Class D and RD units, it's 0.25% annually. These fees are often passed on to financial advisors or brokers who help distribute the fund units. Notably, Class I, RI, and F units don't have these servicing fees. This is a common tiered fee structure to incentivize different classes of investors or distribution channels. It's important to understand their transactional net asset value, or MEV. This is the price at which units are bought and sold. It's calculated monthly and is based on the value of investments minus liabilities and fees. While it aims to reflect fair value, it can differ from the GAAP net asset value. For instance, as of June 30, 2025, their GAAP net asset value was $330,2025. Their GAAP net asset value was $330,2025. Their GAAP net asset value was $330,2025. Their GAAP net asset value was $333.57 million. This difference stems from how they handle certain expenses like organizational costs and servicing fees for transactional purposes versus JCAP reporting. Looking at the cash flows for the 6 months ended June 30, 2025, we see a net outflow of $62 million from operating activities, largely due to investment purchases of $62.2 million. On the other hand, financing activities brought in $218.4 million from unit issuances. This positive cash inflow from financing is crucial for a fund that's still in its fundraising stage, allowing it to make those initial investments. The report also touches on the business environment, noting market volatility in the second quarter of 2025. They mentioned global markets experienced shifts due to trade policy uncertainties and geopolitical events. Despite this, the S&P 500, Nasdaq, and Dow Jones all saw gains. This context is important because it shows the external forces that can impact their investment performance. Onto their cash position. As of June 30, 2025, TPAP had a healthy $156.4 million in cash and cash equivalents. This provides them with good liquidity for ongoing operations and future investments. As of June 30, 2025, TPG had total assets of $342 million. Their investments and cash make up the bulk of this. Liabilities are around $13.2 million, with organizational and offering costs being a significant portion. They also manage currency risk through foreign currency forward contracts, noting a net unrealized depreciation of $0.7 million on these as of June 30, 2020 risk. Through foreign currency forward contracts, noting a net unrealized depreciation of $0.7 million on these as of June 30, 2020 for how. Regarding leverage to plans to limit its leverage ratio to 30%. This means they want to avoid taking on too much debt relative to their assets, which is a responsible approach for a private equity fund. Looking at performance, the total return for Class RS units from inception to date was 5.18%, and for Class RI units, it was 5.25%. Remember, inception was only in June 2025, so these are early returns, but they're positive, which is a good sign. Now, putting it all together, TPG Private Equity Opportunities LP is a new fund making its initial moves. They've clearly managed to raise a significant amount of capital from investors and have started deploying it into various private equity strategies. The high organizational costs are expected, and the investment gains, even if unrealized, are a positive signal. What's interesting here is how heavily they rely on level 3 valuations for a large chunk of their portfolio. This means the reported values are based on their own estimations and the judgment of valuation firms rather than readily available market prices. For investors, this underscores the importance of understanding TPG's valuation methodologies. The fund is clearly in its build-out phase. While the financial results for this period show growth in assets and a net positive impact from investment gains, the high expenses are a key factor to watch. The alignment of interest through performance participation and management fees is standard for the industry. Overall, TPOF seems to be off to a solid start in terms of capital raising and initial investment performance. The key will be how they manage their expenses and continue to generate those unrealized gains in that level 3 valuation space, turning them into realized profits over time. It's a promising picture for a fund that is just launching its investment journey. Alright, that's our deep dive into TPG Private Equity Opportunities LP's latest report. What do you think about their strategy and these early performance numbers, especially focusing on those level 3 valuations? What's your take on how they're setting up for the future? Share your thoughts in the comments below. If this breakdown was helpful in any way, do give this video a like, and if you want more of these corporate deep dives, subscribe to the channel. We also have a fantastic community over on Discord. All the details are in the description below. Thanks for watching, and we'll see you the next one.